Welcome back to Switzer. For months, Roger Montgomery has been sitting on cash. He's told us that on the show. So has Donald Trump created the sell-off Roger had to have? And last week he got the hots for Healthscope. So let's just see if he's still got the hots for Healthscope. How are you, mate?
I'm well.
Now, let's start with Healthscope. Because
sure.
The health sector's really copped it, and you wrote a piece for the Switzer Super Report and it got a lot of reaction. Tell us what's the analysis behind it, Roger, that makes you think Healthscope is a good buy?
Okay, so the market has overreacted to... It's treated as permanent, a downgraded comment by the company, saying that in the first quarter of this financial year, 2017, they've noticed some indications of a slowing of admissions. Now, when you drill down a little bit further, it was orthopaedics and ophthalmology. And then the market, they then said, and I don't know why they said it, but management then said that if conditions that have occurred in the first, actually in September, which was the sort of the volatile month for them, if that continues for the remaining 9 months of the year, then guess what? EBITDA growth will be flat. Now, the market had been expecting about 10% growth, which we had as well, and then the shares have down about 30% from their highs. So now, this is a...
Why do you get a reaction like that for?
Well, because the market's not rational, Peter, right? So it overreacts all the time. And so what do we know? We know that the number of people over the age of 65, and I'll come back to why 65-year-olds are important in just a minute, but the number of people over the age of 65 will double literally in the next 15 years, right? And the number of people over 85 will double over the next 15 years. Now, they're the two biggest cohorts, 65 to 74 and plus 85. They're the two biggest cohorts requiring medical admission in Australia, and they're the two that are growing in terms of population size the most. And the percentage increase in admissions of that age group, of course, confirming what I've just said, is going up. Now, that's not going to change anytime soon. There might be a bit of noise month to month, and if people have got a bad knee, for example, or a bad hip, they might hold off, but eventually they're going to go in for surgery. And the baby boomers were the first generation to take up aerobics and jogging, and there's going to be a lot of hip and knee replacements required. So what else do we know? We also know that, for example, 2/3 of all elective surgery is conducted by private hospitals in Australia. We know that admissions to private hospitals are growing at 4% per annum over the last 5 years, compared to 1.6% growth for the population. So, as I said, these are long-term trends. They're not going to change anytime soon. They'll go for decades. Share prices will go down. Inevitably, if Trump wins, they might go down even further. Who knows? I don't know if Trump's going to win, and I don't know if share prices are going to go down if he does win. But if they do, we see those sorts of things as opportunities.
Now, obviously, despite Healthscope's management's surprising comments that clearly surprised you, do you have a lot of faith in that management?
Yeah, well, they came out... The funny thing is that they were interviewed by the Financial Review the following day because of the very severe reaction in the market, and they were asked about it. Now, typically, we're not enamoured with management who makes comments about share prices. We don't think it's in their remit.
Won't.
They shouldn't. They can't do anything about the share price anyway. But they did comment, and they said it's a bizarre overreaction. There's a 9-month waiting list for elective surgery in Australia. If the government takes on longevity risk on their balance sheet, it's going to be a major problem, a fiscal problem for the government. So they don't want that. It costs the government $2 to $3 million per bed to manufacture a bed, and it costs private healthcare in Australia $1 million to construct a bed. So it's more efficient for them to do it, and it takes all the...
Well, just from my view, you're not saying the bed actually costs $1 million.
Not the bed, but the construction of a hospital and the car park and all the infrastructure that you need, divided by the number of beds, about $1 million a bed. And so it makes much more sense for private hospitals to be looking after that for both reasons. They're more efficient.
Growth for Healthscope on
of course, basis. Of course.
Okay. So, and what has been the reaction of the share price in recent times?
Well, it fell 30% from its highs. I think it's at sort of $2, circa $2.20. I haven't looked at it for the last few days, but that's off from $33.15 or thereabouts at its highs. It's rare to get an opportunity or an overreaction in a business that has such obvious, clear growth prospects.
Okay, and you've alluded to the issue, which I'm going to bring up now, and some of the experts have alluded to when talking to me, is that there's government risk with this company.
Oh, sure.
Yeah, but what's your view on the, the scariness of government risk?
Yeah, there's always a worry dealing with, 90% of Healthscope's revenues come from the government, come from private insurance, or the veterans scheme.
There's a government
and so
impact on their revenue.
Yeah, indeed. But think of what's the alternative? The alternative is the government starts looking after more patients in its public hospitals. That is more expensive for the government, and so the incentives are all in place for the government to push people onto private health insurance and to make sure they use it.
Okay. Let's address an issue that a viewer sent in, and I've discussed it with a couple of the experts on the program, and he read something you put on Livewire or something like that, where you kind of were saying that you were probably building up your cash reserves.
Yes.
But he interpreted that, and he asked the question, should I cash up because there's going to be a major sell-off?
Okay, so there has been a major sell-off.
Yeah.
Already.
Yeah.
So we've seen it in the last month.
Yeah, we've gone from...
In the last month, we've seen any number of stocks that have fallen from 20% to 45%. The Reject Shop, for example, is down over 40%. There's a litany of companies and good quality businesses in some cases that have been treated as though whatever they've announced, in some cases, whatever they've announced, which is temporary, they've been treated as permanent, or they've just come off because they were high beta stocks or they were high PE stocks. There are bargains about now. There are really opportunities.
So you're happy,
we cashed up.
happy when you were cashed up?
Well, we were having, and I think I might have mentioned this to you, our investment committee meetings were literally no longer than about 5 minutes. We'd walk into the room, we'd sit down, look down our scans and all the filters that we use and all the quant side of the process. We couldn't find anything that was deserving of our attention. Everything was expensive. So we were building up cash. When we sold something that was expensive, that went into the bank account, and we built cash up, and we're about 35% cash. And since then, the market for the sorts of things that we like has fallen a lot. And as I said, we've had stocks fall from 20% to 45%, and this is an opportunity, Healthscope being one of those. And so we were right about that, and now the opportunities are being presented.
And one company that you've always liked, Challenger's, had a really good run.
Yeah, absolutely. And we think its long-term prospects look great. So the question is, do we trade when we think it's fair value and in anticipation of the share price dropping and it becoming cheap? What if we get that wrong, then we're out of it? So we hold on to high-quality businesses generally.
What's the latest on Isentia? Because that was...
Well, it's another one that's come off quite a bit. Nothing's changed in terms of the business prospects. We think the opportunity overseas is very large. We think it's profitable. It generates very high rates of return on equity. But in the interim, the share price can drop 20%.
We've seen, and we're reading that there's a rotation out of a lot of the mid-caps, the small caps have done very well.
Yep.
And there seems to be a lot more interest in top 20 stocks for the first time in a long time.
So
what's going on there?
So that's a dangerous rotation. That's one of them. The other
I thought you'd be worried about that.
The other one's into materials and resources. Very few companies
in there that you like in the top 20.
Well, there's not many that are growing. So Telstra's earnings this year were precisely the same as what they were over a decade ago. The perceived security, because there's a dividend stream there, for example, I think that's a trap, because if interest rates do end up going up, then those dividend yields won't look as attractive, and we'll see these companies fall a lot. The other group that's very expensive, or has been very expensive, is infrastructure, Transurban and Sydney airports and Auckland International airports, and they're expensive because everyone in my industry uses the weighted average cost of capital to value the cash flows, or to present value the cash flows. And of course, these companies have no equity, they're all debt funded, and so you've got very low interest rates, which makes them look really cheap. So what we've ended up with is the most expensive companies in the world are companies with lots of debt or companies with no growth. Now, those two things can't coexist for long.
1 minute to go.
Yeah.
What company are you holding that you think has been, apart from Healthscope, has been ridiculously sold off? That looks like good value.
Realestate.com.au.
Yeah, that was good.
REA Group.
Clobbering today, wasn't
yeah,
it? You like REA?
Yeah, it's in the 40s now, and it was in the 60s. So, you know, there's a company with very bright prospects. We're going to need to do a lot of work on what the implications of lower listings, if that were to continue. My thesis is that in a mature market you don't have as many listings. Sorry, in a boom market you don't have many listings, but in a mature market you get more people trying to sell, so you get more listings, and that'll be good for them. And they've got pricing power. They just raised their prices by 10 to 15% depending on your geographic location.
I know we had,
on the 1st of July.
We had John McGrath on Monday, and he was saying volumes are down at the moment.
Yeah, they are.
And his expectation is next year that could change. And he was saying also that the selling costs are so high that a lot of people are actually pulling back from actually selling.
Yeah, and the other thing, well, the reason it's not the selling costs that are so high. The issue is there hasn't been a lot available for sale. So if you and I were to sell our place, where would we move to? There aren't many places available.
And
can I just
stamp duty impact?
Can we very quickly just finish on resources?
Quickly,
very quickly. It took 8 years to build up production to the point where everyone saw there was going to be oversupply, and the prices of iron ore and the like dropped. Now, when the iron ore price jumps again, remember it's only the press of a button, and you've got production coming online again. So it won't last.
Okay, mate. You heard it here first. You said it before. That's Roger Montgomery. Thanks for joining us on the show.